Billionaires, the richest and most successful people in the world, and this goes back to J.D. Rockefeller in the late 1880s, he figured out that the best way to protect, manage, and grow his wealth was to build a team of professionals that worked solely for his family.
We made $1 million of personal income. And I remember how excited I was. And I was looking at the tax return and I was going through, wow, patting myself on the back, super excited. And then I scrolled down to where it said how much you owe in taxes. And I looked at that number and I thought to myself, you know what? I could have bought a house with that money.
Now, with the proliferation of technology and these strategies can be scaled down to lower middle market business owners doing 7 to 9 figures a year. That is what has led us to the Fractional Family Office. Jim, welcome.
Thank you.
This is our first book club.
I know. I like it. 2-person book club.
I've never been in a book club. Were you in a book club back in the day?
I don't think I was in a book club.
I
don't think I qualified. I think I might have gotten kicked out of a book club.
Yeah. Well, I heard now that maybe book clubs, it's not really about even reading the book. You kind of just go and it's an excuse maybe to drink or just hang out and socialize under the guise of a book.
I never heard of those book clubs. I always thought book clubs were like for old women librarians who, on the weekend, they would do that.
Yeah. I think it's a broader, target market these days.
Yeah.
But this is our book club.
I know.
Where's the 2-member people in here?
I like
and what we're going to do today is we're going to start going through our new book. We see here, the Billionaire Wealth Strategies for Entrepreneurs, the Fractional Family Office. And so what we're going to do is we're going to start going through chapter by chapter. Each of these will be micro podcasts. And we're starting out today. And we're starting out today with the introduction. And where I wanted to start is the kickoff story we have in this book is about when you and Mimi crossed that 7-figure threshold for personal income and all of the problems that created for you, which I think eventually led to the creation of the Fractional Family Office, which we'll get to in a future episode. So maybe fill us in on this, what we're calling $1 Million Wake Up.
Yeah. It's funny that I think about as my life journey started and Mimi and I were first together and I was a school teacher, public school math teacher. And I remember I made $20,000 my first year. My last year teaching, I was math department chair. I made $25,000, which was my record year for being a teacher. Yeah. And I used to tell Mimi, I said, gosh, if I just could make $50,000, I would have no problems. And then when I made $50,000, I said, if I could just make $100,000, I would not have any problems. And when we started our company in 1999, kind of the big goal for a lot of entrepreneurs was $1 million of personal income, 7 figures of personal income. It sounded enormous, sounded like you would have more money than you knew what to do with. Of course, we weren't always thinking about taxes, which kind of comes to the story. And that is when we finally hit that threshold after being in business for 14, 15 years, we made $1 million of personal income. And I remember how excited I was. And I was looking at the tax return and I was going through, wow, patting myself on the back, super excited. And then I scrolled down to where it said how much you owe in taxes. And I looked at that number and I thought to myself, you know what? I could have bought a house with that money. And not just a little house, like a really nice house at the time. And then I realized, boy, maybe it's not what you make, but it's what you keep. So I went to my CPA. He had been our CPA since I was a school teacher. And I sat down with him and I said, hey, what are we going to do about this? And he said, congratulations. We live in a great country. You got to pay your fair share. And I said, yeah, I get that. But what ideas do you have so that I don't have to pay as much in taxes? And I'll never forget it. He said, well, how about these 3 things? He said, first, maximize your 401k. I said, well, we're already doing that. He said, buy a bigger house. So the interest you can deduct, that's going to help you, and give more money to charity. And it struck me at that moment. I thought, boy, you know what? These are elementary school ideas, and I need graduate school ideas. And that's when I started thinking about there's got to be more, not just for taxes, but for all areas of wealth building.
Yeah, and I think that was the introduction to you, that there's a different game that can be played. And I think that was the realization, perhaps for you and Mimi, that you're not playing the right game when it comes to wealth building and wealth creation.
Yep, exactly right. It was like we were just using basic strategies that the average person use. And when you're an entrepreneur making a lot of money, it opens the door to billionaire strategies. That's the title of our book. And I didn't know any of those. So that was kind of the quest, is to get all of that stuff dialed in.
And I think a lot of entrepreneurs have that type of reckoning moment where maybe they feel like they've outkicked their coverage, whether it's a huge tax bill, whether it's a huge lawsuit, whether it's key employees leaving and the business has never felt more fragile, or maybe the business is doing great and they're having a liquidity event, and that's the first time they really realize, oh man, I'm about to create a lot of wealth for myself and future generations, but I don't know what I'm doing. But I think where we like to come into play is and start when we are talking to entrepreneurs who have one of these realizations is to first take stock of where you're at. And to help our entrepreneurs visualize that, we have what we call the Wealth Mastery Matrix. And so why don't you go through just and help like visually explain or what that quadrant system looks like.
Yeah.
And so an entrepreneur can self-diagnose where are they at in this Wealth Mastery Matrix.
So if you think about a quadrant with 4 squares, and on the horizontal axis, you've got is wealth planning good, excellent, or poor. And on the vertical axis, is it hard or easy? And so if you think of the upper left corner of that where wealth planning is easy, but the results are poor, that would be the ostrich. And the ostrich usually says to me things like, I just don't have time to deal with all this tax, legal, insurance, investment stuff. I'm just head down, taking care of my family, building my business. I'll worry about that later. And obviously it's easy to be the ostrich. You just avoid and ignore things, but the results are almost always poor. Then if you go in the lower left quadrant, that is the juggler. And it's hard to be the juggler. And just like the ostrich, the results are usually poor. And the juggler will usually say to me things like, gosh, Jim, I've got all these balls in the air. I know I got to try to think about what I can do for taxes, what kind of insurance I need, what kind of legal structure, do I need estate planning, all those different areas that you would be consumed with as the juggler. And yet you're probably dropping some balls and struggling in certain areas. So it's hard and you get poor results. Then if you go to the lower right quadrant, that's where your wealth planning is hard, but it is excellent, the results. And that's the air traffic controller. And just the way you would imagine an air traffic controller, it's hard because you have to pay attention. You have to watch all the flights. You have to make sure nothing's hitting each other. But for the air traffic controller and their wealth management, that's the person who has amazing professionals in all areas, amazing tax professionals in legal and insurance and investment and banking and all those different facets of a good wealth management plan. But the entrepreneur is in the middle of that team, running that team, which is hard. Then ultimately you want to move to the upper right corner, and that's where wealth planning is easy and the results are excellent. And that's the family office structure and what we like to talk about, the fractional family office. And that's where you have amazing professionals in all those areas, but you're not the one that's coordinating. You're not the one holding everyone accountable. You're not the one implementing the vision for the entrepreneur. That's being run by your what we call a linchpin partner, which is your family office guide or lead.
Yeah, and I think one important caveat there too is when we're talking about what is the fractional family office, the way that we like to describe it at a high level is the billionaires, the richest and most successful people in the world, and this goes back to J.D. Rockefeller in the late 1880s. He figured out that the best way to protect, manage, and grow his wealth was to build a team of professionals that worked solely for his family. Meaning, think of your tax preparer and tax strategist. Think of your asset protection attorney. Think of your insurance agent, your investment advisor, bill pay, philanthropy. All of that stuff was done in-house by J.D. Rockefeller's team, and he was just floating all of the W-2, right, the wages for there. That created what is called a family office. It's really just an office of professionals working for the family. And so this is now scaled, whereas you look today, every single billionaire from Elon Musk to Oprah to Jeff Bezos to Zuckerberg and Chan, they all have these billionaire family offices. And so the big idea is now with the proliferation of technology and these strategies can be scaled down to lower middle market business owners doing 7 to 9 figures a year. That is what is led us to the fractional family office. So the big idea is take that billionaire approach to wealth management and then take that down to entrepreneurs doing 7 to 9 figures in revenue per year.
Yeah, that's the game. And the reason with the fractional family office is because doing that the way Rockefeller did is very expensive. I mean, to have all those W-2 employees, if you just had a great attorney, CPA, insurance person, if you just factor that in, you're probably $2 million a year at a very minimum in payroll, plus to set it up, probably another $5 to $10 million to set up. And of course, Bezos and Musk and those folks are spending $30 or $40 million a year operating costs to run their family offices.
Yep, and I think that's where when you look at the benchmarking studies, until you have $200 to $300 million liquid net worth, that's usually where it starts penciling out to perhaps build your own family office. Less than that from a liquid net worth perspective, that's where that fractional family office comes into play.
Yeah.
And one thing I would say too, as an example that we do going through in the book too, is now when we created that wealth mastery matrix framework, it was interesting that I grew up in a household with an entrepreneur father, started his business back in 1987, agriculture business. And when I was self-diagnosing where he would be probably between the air traffic controller and the juggler, because he never had a wealth advisor. He never thought that a typical financial advisor that you could pay the 1% fee was worth it. So he managed all of his investments. He followed Buffett. He read up on all of that. Every night, I remember he would be in his chair after a hard day of work, and then after we ate dinner, and he would sit there and be reading the Wall Street Journal. He'd be looking at all the different commodity prices because he was in agriculture. He'd be reading Bradford Tax and different, tax envelopes, Kiplinger's. He had subscription there, so he had a good team, a good CPA, a good attorney. He had all the team around him, but he was for sure in the middle of that wheel. So it's interesting looking back of he achieved great results, but I can't help but wonder about what were the opportunity costs. Yeah. And I think it's like those hours, countless hours, hundreds, if not thousands of hours, could those hours have been reinvested in bettering his health, bettering his relationships, whether it's with my mom, his spouse, or with us as kids, what could be just pursuing hobbies, things he loves. So I think that's the biggest thing is that when I look back, I think there's an opportunity cost. Yeah. And I think the opportunity cost is in the most valuable thing we all have, which is our time and our energy, because there's no getting that back.
Well, and not only that, just the time he would have spent focused on his business to grow his business instead of worrying about all those other things. That's another opportunity cost.
Yep. Awesome. Well, that's going to wrap it up for this very first introductory chapter. We're going to have our next episode jumping into chapter 1, where we're going to deep dive into what does make rich real mean, because that's the bedrock of all financial planning, all fractional family offices, is what does make rich real mean to you and the entrepreneur. So catch us back next time when we talk through that.
Sounds good. Thanks, Bryce.
Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Dew Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dewwealth.com, or upon request.